CFL just put out commentary that seemed to agree with what we heard from Peter Scheer of Academy Securities earlier. They said the next 500 points for the S&P 500 are going to be down, talking about a 10% correction, similar to what we heard from Peter. Why do you disagree that there is enough ammunition for things to kind of hang in there and even creep higher, even as people really do wake up to real risks that we're seeing with respect to spending?
Well, I think this is a really important question. So the risk from higher for longer is two things. Higher for longer on its own means higher debt servicing costs for companies. That should argue for stocks going down and credit spreads widening. The problem is that the reason for higher for longer is that the economy is good, meaning earnings are good, GDP has been strong. So as a result of that, we should expect stocks to go up. We should expect spreads to tighten. So there's a tug of war between rates higher for longer is hurting, so to speak, in the CFO's office when debt servicing costs are having a negative impact. But if that's happening because the economy is good, I would still expect the economy to do just fine for the next several quarters as a result of the tailwind of the stock market going up, easy financial conditions, tight credit spreads, and also fiscal policies still providing quite a tailwind.
Does that mean that there's going to be a bigger downside on the other side?
That does mean that when we look into 2025, I do think that we'll set ourselves up, because think about the following, exactly as you're saying, Lisa. The fact that we have delinquency rates going up on credit cards and auto loans, even in an economy where everyone has a job, the fact that you have highly levered companies in venture capital, in tech, in growth, enterprise software that are highly indebted and experiencing a lot of problems, that these problems are still here, even in a good economy. That tells you once people do begin to lose their jobs, once the economy does begin to slow down, you already have a lot of distress, including in commercial real estate. There's a lot of office problems, obviously. Imagine what the problems will look like if you finally get the unemployment rate to move higher. So therefore, the sensitivity next year is that we might actually get a risk of a harder landing coming back. But that's not the theme for the next several quarters.